Hello friends, today my subject is financial accounting and the topic is financial statement analysis. So, the financial statement analysis. What is financial statement analysis? The analysis of financial statement is the systematic process of analyzing the financial information in the financial statement to understand and make the decision regarding the operations of the enterprises, or it is the study of relationship amongst various financial figures are set out the financial statement, that means balance sheet and statement or profit or loss statement. So, financial statements consist of the revenue account and income statement. Revenue account refers to profit and loss account, or income and expenditure amount account, or simply income statement. Revenue account may be split up and divided into manufacturing account and trading account, profit and loss account and profit and loss appropriation account. Revenue account is the prepared for a period owing 1 year. This is the statement shows that the expenses incurred or production and the distributions of the product and sales of the other business incomes. The financial the final result of the statement may be profit or loss or particular period. So second one is the balance sheet. The balance sheet is shows the financial position of the business as on a particular date, represented the assets owned by the business and the claims of the owner or creditors against the assets in the form of liabilities as on the date of the statement. Third one is the funds flow statement. It described the sources for which the additional funds were derived and the use of this fund. Funds flow statements help the understand the changes in the distribution resources between two balance sheet periods. The statements reveals the source of funds and their application for the different purpose. Fourth one is the cash flow statement. A cash flow statement shows that the changes in cash position from the one period to the another. It shows the inflow and outflow of the cash and helps the management in making the plans for immediate future. And estimated the cash flow statement enable the management and ascertain the availability of the cash to meet the business obligations. For fifth one is the schedule. Schedules are the part of financial statements which give the details information about the financial position of a business organization. So we discuss the need of financial statement. Financial statement it needs for the first is the profit and loss account and balance sheet. Second, to know the financial condition. Third, to know the profitability position. Fourth, to know the operating efficiency of the firm. So objective of financial statement, the resource using the most efficiency and effectively. Second, honor of the current obligations. Third is the debt reserving ability and fulfillment of the long term obligation. Fourth one is the financial risk, thus the firm undertake. Fifth one is the business risk. Sixth is the earning and stable and adequate. Seventh is the profit retention policy. Next, the divided obligation, and the last is the predicting growth, the rates of the incoming revenue, etc. Now we discussing the types of financial analysis on the basis of material use. External analysis and internal analysis. The external analysis is conducted by those who do not have the access to the details record of the enterprise and therefore have to depend on published account, that means statement of P&I, BS directors and auditors report. Now, internal analysis. Internal analysis is the conducted by the management to know the financial position and the operational efficiency of the organization. Second point in external analysis, such types of analysis is made by the investor, credits and government agencies and the research scholar. So in internal analysis, the important features of such analysis is that the management has access to all information of the enterprise and therefore The analysis is more detailed, extensive, and accurate. So in horizontal analysis, this analysis is made review and analysis FS for the number of the years. It is the time series analysis. In vertical analysis, this is analysis is made to review and analyze the FS of 1 year only. In horizontal analysis, it is shows the comparison of financial data for several years against a chosen best year. It is useful for long-term trend analysis and planning. For vertical analysis, such an analysis is useful for the comparing the performance of several companies of the same types or division or departments in the one enterprises. In horizontal analysis, comparative financial statement is the example of horizontal analysis, and in vertical analysis, example is the ratio analysis of the particular accounting year. In horizontal analysis, it is also knows the dynamic analysis, and for vertical analysis, it is also know the static analysis. The techniques of the financial analysis. First is the comparative statement analysis, second is the common size statement analysis, third is the trend analysis, and fourth is the ratio analysis. So comparative statement analysis. The comparative statement means the comparatively a study of the individual items or components of financial statement, that mean BS and PL accounts of two or more year of the enterprises itself. In comparative statements, amount of two or more years are placed side by side, among which change in amount and absolute and percentage term in facilitate comparison. In common size statement analysis, taking the sales to be equal to 100, all other items in the income statement of the year are expressed as percentage to the sales. In case of balance sheet, the total assets are made equal to 100 and all the other assets are expressed in relative percentage. The same of the case is the same in the case which liabilities with the total liabilities being 100. So this is the example of common balance sheet, which is from the December 31st 2007. We are comparing the 2006 and 2007 in the form of rupees and percent, and 2007 also rupees and percent. We are explaining in the assets of the current assets and the fixed assets and fixed current liabilities. This is the total example of that. So in next slide, it is also common size statement from December 2006 and 2007. It is the net sale, gross profit, opening expenses, and the total operating expenses, the less non-operating expenses. This is the example of that. So the trend analysis. So what is trend analysis? It is determines the direction upward or downward. Under this analysis, the value of an item in different years is expressed in relation to the value in one year is called the base year. Taking the value of the item in the base year to be equal to the 100. The value of the item is different years are expressed as the percentage to this value. Now, the calculating the trend percent of the following X limited taking 2003 as base in interpreted them. It is the example the years sales stock and profit before tax in rupees in lakhs. In 2000 we are if we see in this table, the year is 2003 to 2007. The sales are given over there and stocks are given over there and profit is also given over there. It is the example of it is the example of trend analysis. So the solution of that is the trend percentage. We are finding the trend percentage in the this table. So from the base year is 2003 is equal to 100. So we are calculating the trends here is the 100%, 124.40%. How much the stocks means in trends are given, we are showing in this table. So now the ratio analysis. A ratio is an arithmetic relation between two figures, or and the financial ratio analysis is the study of ratio between various items or groups of items in financial statement. Thank you.